Fear builds walls, but smart investors find doors. Right now, the market feels trapped, boxed in by tariff uncertainty, persistent inflation, and a Federal Reserve that's keeping everyone on edge. Sentiment has turned cautious. Hedge funds are shorting strength, retail investors are retreating to cash, and even minor economic headlines are sending shockwaves through the indexes. It's as if Wall Street is bracing for impact, without knowing where the hit will come from. But amid all this noise, one voice is delivering clarity. Tom Lee, the data-driven contrarian at Fundstrat Global Advisors. While the majority are shrinking back, Lee is stepping forward. He believes we're not just due for a rebound, we're standing at the edge of a potential breakout rally heading into 2026. And the catalyst? A powerful resurgence in mergers and acquisitions. According to Lee, the growing mismatch between current valuations and long-term fundamentals is creating a golden window for deal-making on a massive scale. So today we zeroing in on 3 compelling stocks that could ride the wave of this M&A supercycle, stocks that are quietly building momentum while the broader market hesitates. 1. Twilio, ticker TWLO. Let's start with Twilio, a name the market has largely left for dead. Written off after the tech downturn, Twilio has quietly been staging one of the most underappreciated comebacks in the software sector. But this isn't just a rebound, it's a reinvention. In Q1 of fiscal 2025, Twilio delivered $1.17 billion in revenue, marking its 3rd straight quarter of accelerating growth. Its high-margin communications business grew 13% year-over-year. But the real story lies in Segment, Twilio's data platform, which has not only stabilized, it's back to growth. Why does that matter? Because Segment is Twilio's entry point into the booming $158 billion AI-driven customer experience market. Twilio is no longer just a messaging company. It's morphing into a next-gen customer engagement platform, leveraging AI to deliver conversation intelligence, voice analytics, and generative automation. These aren't just incremental tools, they're long-term competitive advantages. For larger tech giants looking to accelerate their AI footprint, Twilio offers immediate infrastructure, stickiness, and innovation. Financially, Twilio is gaining strength. Non-GAAP earnings are up 34% year-over-year, free cash flow is climbing, and the company is guiding toward a cumulative $3 billion in free cash flow by 2027. Yet, the stock still trades at a valuation that reflects the past, not the future. For strategic acquirers or visionary investors, that's the opportunity. Twilio could be one of the standout comeback stories and a prime M&A target in the months ahead. 2. Salesforce, ticker CRM. Next up is a name you wouldn't normally associate with takeover talk, Salesforce. As a blue-chip tech titan, it's often viewed as a consolidator, not a target. But what Salesforce is building right now is bigger than just scale. It's laying the groundwork for the next era of enterprise AI. Despite a stellar Q1, nearly $10 billion in revenue across the board beats, and expanding AI traction, Salesforce stock took a dip. But savvy investors know, when a market sells strength, opportunity knocks. Underneath the surface, Salesforce is building an enterprise platform that's fully integrated, deeply intelligent, and powered by AI at every layer. Take a look at Agentforce and Data Cloud, Salesforce's flagship AI engines. Combined, they're now generating over $1 billion in annual recurring revenue. In Q1 alone, 60% of its top 100 deals featured AI integration. And Data Cloud? It ingested a mind-blowing 22 trillion records, up 175% from last year. That's not growth, it's dominance. But here's where it gets more interesting. Salesforce is actively shaping the M&A landscape. Its $8 billion acquisition of Informatica Signals, a bold move to unify fragmented enterprise data into one AI-ready platform. While competitors are conserving capital, Salesforce is going on offense. 3. Palantir, ticker PLTR. Last but far from least, let's talk about Palantir, a company that's gone from enigmatic to essential. While the market is obsessed with macro headwinds and headline risk, Palantir is quietly embedding itself into the future of national defense intelligence and AI infrastructure. One of the most pivotal opportunities on the horizon is the Golden Dome Missile Defense Initiative, a next-generation defense system that could exceed $175 billion in scope. While traditional contractors like Lockheed Martin are building the hardware, Palantir is delivering the intelligence backbone. Its platforms, Foundry, Gotham, and Apollo, serve as the real-time AI brains that process data, identify threats, and simulate responses in seconds. This isn't theoretical, it's already operational. Palantir's alliances with defense giants like Lockheed, SpaceX, and Anduril give it a critical role in this defense tech ecosystem. And thanks to its SaaS delivery model, even a modest recurring slice of the Golden Dome initiative could significantly accelerate Palantir's revenue growth. This is no longer a speculative moonshot. Palantir is now GAAP profitable, has strong operating margins, and continues to secure new government and commercial contracts quarter after quarter. With Tom Lee forecasting a surge in strategic acquisitions through 2026, Palantir could either become a prime takeover target or, just as likely, a consolidator in its own right within the defense AI space. For long-term investors, Palantir represents more than just upside. It offers a front-row seat to one of the most consequential technological build-outs of our time. In a market clouded by fear and uncertainty, Twilio, Salesforce, and Palantir are doing something different. They're moving forward, quietly innovating, scaling, and positioning themselves at the center of the next big cycle. If Tom Lee is right, and the M&A wave truly begins to swell, these could be the companies that don't just survive, they define the next bull run.